Hello, YouTube. Today we're going to talk about the potential for a stock market crash and the signal I am seeing here because the last time we went to new highs on the 10-year note, it led to the stock market crash of March of 2022. So is that same thing happening here where the bulls are going to win or put in new highs? That is the summary for this weekend's video. And if we look here to the S&P to March, which is that same pattern we're looking at right here when we went to those new highs, that is when the market tanked. And the second reason why this is very important is because when we look here to the 2-year versus 10-year inversion, or this is called the yield curve inversion, we had it happen 1, 2, 3, 4 times. Now let's look at that same S&P 500 chart to see if there's anything that tells us that we should be a little bit worried about the potential for a crash. Well, 1, 2, 3, 4. Every time it led to a dip, maybe a crash, but at least a dip. And all this means is that we saw a big red candle, which means that the 10-year note actually went up by a lot, and the 2-year note went down by the 10-year note went up, 2-year note went down. And every time we had a big red bar, including April of 2022, including August of 2022, including December of 2022, and March of 2023, that is every time we've had that big red bar. And now that we had this most recent one here, I'm wondering whether that's going to lead to a crash for the market, which would pretty much mean that we're going to be going down. Things are very bullish right now. And I'm sending this as a warning because right now we know that we might be heading to recession, but we are not there yet. So if we think about when inversion started, which is here going back to June of 2022, which is when we breached that 1.0%, that's where the inversion starts. If we think about what Goldman Sachs is telling us here, that since the late 1980s, the time lag between the yield curve inversion and the US recession has been about 20 months. So what does that mean? Well, if we take the date from June, extrapolate that out, we're looking at January 8th of 2024. So this might just be a little bit of a dip. It might be leading to more. And because we know that we take the staircase up and the elevator down, I just want to send out a warning because I see the potential, keyword being potential, for us to head lower. If we're going to head into recession, we're going to have to have a negative quarter. So as we're going into Q3, I think it's going to be very important for us to track where Q2 closes because it just recently got revised up to 2.12, and we're going to get that final reading here pretty soon. We also have to really pay attention this week because if we're going to see that breakout here on the 10-year note, it's not happened yet. The W is in the making. It has not happened. But we do have a key data point coming in on Wednesday. We got CPI, core CPI, and then we also have PPI coming in on Thursday. So we can note here that we're expecting to actually see an increase in CPI, a decrease in core, but PPI is going to go from a negative reading up to positive. All this means is that I see this as the potential for us to go either big up or big down on that reading. I'm going to ask you for a huge favor, please, and thank you too. If you could, please consider smashing that thumbs up and subscribing to the channel. We're going to walk you through the rest of the story now. So we showed this chart, I believe back in March. It was the psychology chart for QQQ overlay on a line chart. We note that where the bulls are, well, it's almost a perfect line where we note that now, most recently going into July, we have a little bit of a tick down, and it looks like performance chasing is driving the market, which is another reason why I have that buzz coming off of my head saying it's time to be prepared for us to go down. We also gave an update at roughly 300 on QQQ, talking about a turning point. I believe we are at a very similar crossroads now where this roughly 370 area has been very hard for us to hold. We've poked over a few times, but we're failing to hold it. So there's your bull update. And now we're going to briefly go through the potential for a bull, a new all-time high on the S&P 500. So that would mean that there's a 5-step pattern here. Number one is that we go to a crash lining to the 50 moving average in 2 candles. Number 2 is that we poke below the 50 MA. You can see that here by number 2. Number 3 is that we actually breach the high from candle 1, like we did back here in 2020. And then we look to a 4 or 5 month expansion. That's going to be this expansion zone right here, ultimately dipping back down a little bit below. We haven't quite formed that higher high right now. So I'd be looking for consolidation and new highs. So because I've been talking about, again, I call it a crash, but it might just be a dip like we looked at here, right? This is more of a dip like we saw in December, like we saw in March, right? That's the end of the year. That's SVB. So it might be a dip. It might be a crash. And what I really want to pay attention to is whether or not this pattern actually breaks. So if we do actually get that sell, I want to see where we close out. This one was a slightly lower low, and then we just form higher low, and then higher highs, which means a fresh expansion. That's how we went to new all-time highs. And if you want to follow me on Twitter, the link to my profile is in the description. I shared all of this on there, and I'm making an effort to engage more. Another thing we want to talk about for the bulls is that they did make progress by holding on to extreme greed. So we look here to our history, our timeline, and we note that I said I wanted to see a higher high. Well, we did from 81 up here to 83. That's a higher high. And for the low from 72 up here to about 78, that's also a higher low. So the risk now is that we're clearly pointing up. Are we going to be able to get above that 83, or are we going to fall back below 72? The bulls want to see us over. The bears want to see us below. As we go through for the rest of the things that could drive the market this week, we will circle back and look at some charts a little bit later to get a sense on where the market could go. So understanding what should happen this week, we can note that we do have Delta Airlines and Pepsi reporting earnings before the bell on Thursday, and then banks kick it off on Friday. That's going to be important for me. Why? Hey, banks are like really, really, really tied to inflation, to interest rates, and all that good jazz. So we talked about the core CPI coming out on Wednesday. We talked about initial jobless claims and PPI coming out. We also have consumer sentiment numbers coming out and inflation expectations coming out on Friday, but I don't really think those are going to move the market. Anyways, here we talk about who is going to blink first. Either the 10-year note is going to dip down, or if it goes to new highs, the S&P is going to have to blink. The bond market is bigger than the stock market, by the way. It's usually right, and the stock market usually follows kicking and screaming. Here we're also looking at inverse TLT or 20-year treasury bonds, and it shows us a pretty clear pattern. A massive W, which is going to be the green line, or a win for the bulls, and then also a massive cup and handle where we form our high at 24, come all the way down, come all the way back up. There's our handle, and we've now bounced off this 50 MA multiple times. This looks bullish to me. So as I look forward here to the reasons why this might happen, well, here we're looking to July 26th, and this is the CME Fed tool. It basically tells us what people expect is going to happen at the next meeting. So we know we have a meeting coming up on July 26th. The market thinks there is a 93% probability we get a 25 basis point hike. And the way, again, one more time that I could see this 10-year note actually breaking higher here is if this happens. And what this means is that we're going to be seeing this get repriced. So just pay attention to these numbers for me really fast here, please. It's to 26th of July, and it's at 525 to 550, which means they think we're going to raise once. However, that's the same number we see here for September, which means that means pause. There's a 70% chance priced in right now we get a pause in September. That's not what I've heard from any Fed officials. And we note that we have a 5% chance of a cut and a 24% chance of a hike. If we continue the story here, what this really comes down to is JP Morgan told us that they see a risk of us going to 7%. Well, that's going to mean the 10-year note's going a lot higher than it is now. Right now it's at 4%. So I think this was part of what got the market on edge. And I think it's something we have to be mindful of. If we look forward to the next article now, let's just close that one out. Look forward to the next article. Larry Summers warns on inflation complacency, sees more bond declines. This guy was right on the ball. He called it early. He called it sticky inflation. He said transitory is a little bit silly. And he's also telling us that, so bond declines just mean that we're going to be going higher. He's basically saying we're going to get this breakout here. So this guy talks, I listen. He's not always right. He's sometimes early, but he's often, he's correct often enough that I need to try to understand what he's seeing, right? He used to run the Treasury. He used to have Janet Yellen's job. So here's what he sees. Sees further increase in medium-term interest rates. Former Treasury chief says June job numbers were hot. Well, tell the market that. If the market thinks the numbers are hot, why are we where we are? And here's the numbers that came in on Friday. So jobs day in America, June payroll data. We saw payroll from May go to 300,000 down to 200,000 in June. But there was a revision here, which means that the May number actually got revised down. Unemployment rate actually ticked down from 3.7 to 3.6, which means that's not what the Fed wants to see. Participation rate was right in line, 62.6. And then average hourly earnings, which is the potential for that wage price spiral, hovered at 0.4 or compounded annually at 4.4. Still too high for the Fed. Last thing I want to point out here before we try to finish off the story is just I also noticed that a lot of these names are hovering right around a round number. Look at Apple, 2.999 trillion. Apple has always had trouble around the $1 trillion number. 1 trillion, 2 trillion, 3 trillion. It has always sold off hard. Second biggest block in the market, Microsoft, 2.50 trillion. Nice and round. Then we look at Google. Google is right here at 1.52. So those companies are right around those big numbers. I believe there is a pivot, which means we're going to be getting a move soon, a decisive move. And if we look here, it might be due to the complacency from the bears. So bears are unwinding equity bets at the fastest rate in 3 years, going back to 2020. We all know what happened when they went from net short to net long. Getting above zero means they actually went long into September of 2020. And if we look back here on the chart, September of 2020 was a great time to buy. We know right here, right? There's the dip. Sorry. There's the move to new all-time highs. That same pattern we pointed out to you on the monthly. We dip down and then we rocket higher. So that's just me showing you what happened on the weekly chart relative to that monthly one we just pointed out, which led to those new all-time highs. There we go. All right, let's finish off the story here. So here is the update. Last time we shared this was in March. We were somewhere here between bottom feeders and bargain hunters. Well, now, if you look at the line chart nice and close, we note that we're all the way up here at performance chasing. So we need to either break up or we're going to break down. I'm going to ask you one more time, if you're still watching, please, and thank you. If you could, please consider smashing that thumbs up and subscribing to the channel. We also have a private group. So if you want to come join me, Justin from YouTube, and see what we do after we sign off, you can join us for 14 free days to trade with me. And you can go to the website, thealgo.com. If not, I really encourage you to follow me on Twitter. Links also in the description. I think I put out a lot of free good content, and I would appreciate your support. So as we're looking here, we note that where the bulls are. Well, I'm seeing a lot of performance chasing. Everyone's bullish now. So I'm like starting to look at the other side of the trade. Contrarians are the ones who make oversized returns in this market. So we had the turning point number one, which no one wanted to believe. We went from 300 to basically 25% higher, almost in a straight line. No one believed it. And now I'm wondering whether we have another turning point for us to continue higher, which would mean we're not just going to go to performance chasing. We're going to go into a new bull market, new all-time highs for the NASDAQ, or we're not. And with earnings kicking off with Netflix and Tesla next week, I'm like trying to really think about, why are these stocks running so hard into earnings? Let me go back here. Let me go to QQQ. My concern here on the weekly is just that, let me make sure I have the right board here. This is the one that I wanted here. So there we go. There's the weekly. My concern here is just that we're running like really hard into earnings. So we better crush numbers, or we better have some more hype on AI, because otherwise this apex here, I don't know. That's why there's a question mark. I'm really prepared, because we've taken the staircase all the way up, right? Staircase up, staircase up, staircase up. And the crash can mean we take the elevator down. I'm not saying we're going to go to new lows. It might just be a dip, a correction. A 10% drop would be very healthy at this stage in the cycle. So with that said, that's everything I wanted to really go over. Now let's look at a couple of charts, because I think that understanding the backdrop of the fundamentals is important, but looking at charts is also going to tell us what the market is currently pricing in. So let's have a look here at S&P. Because there were some very clear notes we left you with a few weeks ago, and they're still materializing here. So this is just a warning for now. I'm not saying a crash is imminent, but I'm personally getting prepared for it. I'm seeing a lot of things line up, just not sure when it could happen. It could be all the way until January of 2024 that we have to wait for that recession to actually materialize. But looking at S&P here, what do we know? Hollow candle signal the expansion is continuing. Lower lows is a warning. So what do we have? Well, we don't have a hollow candle. We closed lower than we opened, which just means that we're more bearish on Friday than we were on Tuesday when the market opened. And then lower lows are a warning. We also don't have that. We have a tight inside bar, 444.3, 444.0, tight bar, no hollow candle, no lower low. So what does that mean? It means I'm giving you a warning or an alert or whatever you want to call it, that, again, we're over the 50 moving average on the weekly. We're over the 200 MA, which means we're over short-term price. We're over the long-term price. We're trending up. We're over resistance, which we took out from August of last year. I'm just prepared for what could happen next. Everything says bullish, but as we know, everything is bullish until it isn't. So do you want to find out things are not bullish after the fact? Or do you want to have a warning that, hey, you know what? When a green light is flashing, I got my pedal, I got my foot on the gas. When the yellow light flashes, I put my foot on the brake. I'm not slamming the brake, but I'm prepared to stop. That's what this means for me. Hollow candle stop. Hey, there's potential for us to dip. If we have a lower low, that is a warning. Two lower lows closing below the low, that would start to be confirmation. We don't have notable red volume yet. Why? We just showed you those bears are running for the hills. They've covered at the fastest rate in more than 3 years. We've also not been able to put in back-to-back red weeks, right? One red week, 2 red weeks and back in May, one couple of here back to March, February, and then SVB. So the bulls are just like picking up all the momentum. So as long as we keep forming those higher highs and on greed and on price, I think we can continue the melt. At some point, we're going to have to form a back test, though. Just not sure where that is. Looking at QQQ, we talked about this one pretty extensively, so I'm just going to leave it there. Looking at the dollar, here's where I get a little bit more unsure because we are no longer pointing up. This should be supportive of stocks, by the way. The head and shoulders is working out. We're trending down. We're down on the week. So here's the funky part. S&P down on the week by about 1%. QQQ down on the week, down by about 1%. Dollar down on the week, down by about 0.5%. Okay. 2-year note up about 1%. Nice rally here, right? It's going for the highs. This is the highest closing price that we have seen going all the way back here to 2007. Well, 2007 wasn't the crash. It was 2008. Woof, right? So again, just be prepared. That's all I'm trying to ask. Please be ready. And then the VIX. It doesn't look like it, but that was a pretty good week for the VIX. It's up by about 9%. It's way down into the low teens, which means the market is calm, cool, collected. And what's it saying? You buy insurance when you don't need it, not when you do. And right now, no one wants insurance. No one seems concerned. So maybe it's time. Maybe it's a time to consider it. All right, I'm looking at a few more charts here. Let's have a look at RSP. We're going to have a look at DIA and then probably IWM, and then wrap it up there. So here's what I'm noticing. RSP actually formed a higher high and a higher low on the week. It did not just form consolidation, which means the average S&P 500 stock actually had a more bullish start to the week, and it is holding the gains better. It's a hammer. Hammers usually mean we're going to go up. So the equal weight S&P 500 looks pretty good. Now, if we look here to the Dow, here is where it's, again, still trending up, which is going to be our green line. We're still above averages like the 50 and the 200, which are the blue and black lines. We're right around support. We've just not, right around resistance. We've just not been able to break out. So this is an ascending triangle because it's pointing up, but it cannot break over these highs, right? 4 or 5 taps, it just can't quite do it. It cannot claim those August highs that the S&P is already over. That's a warning. Looking here to IWM, this is where I'm not sure what this is. It could be a head and shoulders, right? We see the shoulder, we see the head, we see the shoulder. It is not over August highs. It is not at 2023 highs. Or this could be a base forming here where we have some kind of cup and handle. We form our back test and then we launch off. The reason why I'm confused on the IWM chart is because, well, we have a death cross, which means a lagging indicator, which tells us that we're going down. And we're bouncing nicely off the averages, closing over the 50, over the 200. That looks constructive. We don't have bullish volume. So I'd want the price to tell me we're bullish by breaking above roughly 200. Finally, looking here to 1 or 2 more quick charts. Let's just jump down to the ones that I think really matter here. Healthcare and then financials. Then we'll look at the rest of the world. So healthcare here, right? Sell it. This usually does well in a recession. So this is a defensive play. People have been dumping it so far into the beginning of the third quarter. So let's pay attention to it. That's a pretty big red candle. It's down by about 3%. On the flip side, though, here's where things get interesting. Financials are trying to go up, only down by about 1/3 of 1%, battling for that 50 MA and trying to break out here. So gathering up steam to maybe put in a W. Well, maybe. Looks constructive. Again, just lacking that volume. But nice lower tails here, which signify dip buying. And then finally, let's look at the rest of the world because we've been saying this is a global theme. Well, the DAX got a big old slam down by about 3.5% this week. And what I noted earlier in the week is that the reason why this is particularly interesting to me is because we have all these lower wicks here for the last couple of weeks, actually going all the way back to April, and we closed below all of them. So what does that mean? That's a washout. People have had 1, 2, 3, 4, 5, 6, 7, 8, 9 chances to buy in the zone, which means roughly 15K 500. And now they're like, screw it, sell it, get out. We talked about interest rates needing to rise in Europe. That could be part of the reason here. Then we got FXI. It looks like ARK, where it's unable or unwilling to claim the short-term price or that 50 MA. And this is supposed to be the second biggest growth engine of the world, right? Second biggest economy. Well, it kind of stinks right now. There's no growth in China. That's what it looks like. Emerging markets over the 50 MA, but still struggling. It's having a hard time pushing off, right? Try to push off, falls down. Try to push off, lower high. Bouncing off the 50, I'm not sure. So what do we got? High, lower 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 high. It cannot catch momentum or change the trend. So with all of that said, thank you so much for watching. I think I laid out a lot of notes. Hopefully it's not too complicated. If you want to find out more, please watch our weekend video now queued up here on the left-hand side. If not, maybe you want to consider joining us for that 14-day free trial, the Trade With Me, Justin from YouTube, because after I prepare all these notes, I make a clear action plan and I buy stocks based on what I think is going to happen for this next week. With that said, thank you so much for watching, and I look forward to seeing you on the next one. Thank you again.